meeting does not have a resolution. This is a briefing on where we are on our financial plan. We've been working mightily on this, and Robert's going to bring you up to date.
Thank you. The purpose of our conversation today is to talk about where we are, what we're looking at for the financing structure. We're not going to take any vote today, but hopefully we can begin to address the questions and issues that you guys have. So that as we work through this financing structure, when we do come for a vote, hopefully next month, we put this together in such a way that everybody understands and would agree this is the best way for us to finance our project. At the start of the meeting, I passed out a page to you that had 3 columns on it. And I'm sorry, I'm a paper kind of guy, so we're going to work off paper today. We're going to start at the far right-hand side of the page. One financing option we have is to do $190 million in totally senior debt. And that's what the proposal is in the far right-hand column. If you look down just a few lines, one of the things I would look at is the cost of issuance, and you would see for us to issue $190 million in totally senior debt, you'd see $3.8 million in issuance costs. The next thing I would look at is the rate that we would expect to pay for these bonds, and it's 4.88 is the rate that would be expected to be paid. Now then I'm reminded when I talk to the bankers, and I talk to our bankers, what Harry Truman said about economists. Harry Truman said all the world needs is more one-armed economist. Because everyone you talk to, they will give you a strong case about something, then they'll say on the other hand. Well, when you start talking to bankers about the rates that we would expect to pay, they use this rate because it's a safe rate, and then they'll talk about the reasons it could go up and could go down. I think this is a safe rate for us to talk about today. I think it is correct. It's directionally correct in the right order of magnitude. I do think there is some chance today, and where are they? Don't duck your head. There's some chance if we were issuing today that we could be looking at a rate less than this. It's unlikely that our rate would be more. It's likely that it would be less.
That's correct.
If we were issuing today, it would be
Around 435, 440.
okay, 435 or 440. But I think we can talk about this rate of 488 as being something that's pretty much in the ballpark. One of the things that drives us to consider different scenarios, you'll notice the second line down, third line down, there's something called CAB bonds, and about $20 million in CAB bonds. These are bonds that bear no interest and no principal until their maturity, so therefore they're riskier than what you would typically see in a bond that has some sort of a debt service associated with that. We have to have this under this structure because our debt service coverage, when we first open our road, is closer than what the underwriters would like for it to be. So they say, in essence, we're going to put some of your debt on an amortization and then part of it just pay us someday later. And as you would expect, that drives up both the cost of our bonds and the cost of our issuance because we had some relatively risky instruments in the CAB bonds. One proposal to lessen that impact is to have some part of our debt in subordinated debt. Basically, these guys say, we're going to put the senior debt in the front seat, we're going to drive, if anything bad happens, they get paid. If anything left over after they're paid, we'll take the money. So what would it look like if we do subordinated debts? And that's the second column over. As you can see, if we were to do $60 million in sub-debt, roughly, our issuance cost would drop about $1 million to $2.8 million, and you see 2 interest rates there. The interest rate on our senior debt would drop to about 468, using the same direction that we talked about under the totally senior debt. Our sub-debts are going to be higher because we would understand there's more risk associated with them. So we pay a little bit higher rate on the sub-debt and a lower rate on the senior debt with less issuance cost. Overall, it's cheaper than what we would pay under all seniors because we avoid the CAB bonds. This is likely the scenario that we'll be recommending to you next month. There is a third option that we are considering, and that's over at the far left hand. These sub-debt bonds may be placed in private placement under private negotiated terms between different kinds of lenders, typically hedge funds or other non-bank lenders, but there are folks that like this kind of debt, and they would under a private placement. We did have one offer that Richard and Everett spent a lot of time and the rest of our bankers working heavily on, and they wanted it, but they wanted it at about a 525, 530 rate. And if you look at page, do you see a small print that says present value of debt service difference between the sublane scenarios? $5.3 million. That's the present value of the difference between the private placement and the public offering. That's too much money. So we do not have a private placement scenario that we're suggesting to you today. But we wanted to talk about that and explain that to you. So if you think about it, the reason for doing the sub-debt instead of all senior, you don't have the CAB bonds to worry about. We save the expense and the risk associated with those. We do have improved pricing on our senior debt. It's important because we can do it quicker. If we did decide to do a private placement of the sub-debt, I think we could be funded in 45 days. So we'll have the money sooner. That allows us to move quicker on our project and also gives us a little bit more timing on when we come to market with our senior debt. So it would help from that regard. It takes away some of the TxDOT risk. Right now, TxDOT is not a friendly lender. I don't know if you guys have ever dealt with anybody that was not a friendly lender, but TxDOT is not a friendly lender. Everett, you struggle working with those guys daily, don't you?
They're fine people. They're fine people.
Our life will be simpler if we can not be negotiating with TxDOT in the same vein that we're doing so today. So that the sub-debt would allow us to do that quicker, and I think it does provide overall general flexibility. So the thing we'd like to do is we'd like to answer any questions that you have about the structure that we're going to be proposing, because what we're going to be doing in the next month, we're going to be soliciting more offers to understand if we can get that $5 million narrowed to the point that it makes more sense for us to go with a private placement than with the public offering. Because if we can do it quicker and easier, $5 million is too much. There is a number, though, that would cause us to want to go ahead and go with the private placement sub-debt. We will be back with you with a recommendation on that. We need to figure out what that breaking point is, and then we would have a clear action, especially with our bonds being open. If we were able to privately negotiate the sub-debt, we could move quicker on our project because we'd all like to get under construction to avoid the delays. I wanted to talk to you, and we'll all, Richard or Everett or I will answer any questions you may have, but we wanted to get this in front of you today so you could be thinking about it. We didn't want to bring you a recommendation that said this is what we need to do today, and you guys not had an opportunity to think about it or talk through it or offer any questions or concerns about what we're considering. So, my job was to talk, and it's you guys' job to answer any questions. Looks like, so far, I'll talk and you correct me, it looks like that clearly is the most expensive route that we can go, just from an issuance cost due to the CAD bonds. We just don't have the debt service capacity today to totally float the $190 million in such a way that everybody's loving.
Yeah, I want to just clarify something. The real difference is the CAD, because there's zero coupon bonds, so you pay interest throughout the whole until maturity, which is at the very end, as opposed to paying current interest on a different on current interest loans, basically, or amortizing current interest loans a lot quicker. I wish we could do it today.
You got to work a miracle, catch the low point. We're catching the low part of the draw, which I'd rather have. I think we're great now.
Well, I'm going to tell you, for somebody, you and I can have a drink over a martini. I think there's a possibility we'll have lower interest rates in 6 months than we do today.
On the other hand, yes.
U.S. Treasury, you might know what a U.S. Treasury 10-year Treasury is today? 170. What's a 10-year German government bond? 22 basis points. Would you rather have a German 10-year or a U.S. Treasury 10-year?